and that will be fine. We can wait about, I don't know what time it is. We can wait till 6 o'clock in here in Spain. It's noon in New York, and I don't know what time it is in Montana.
It's 10 in the morning in Montana.
10 in the
So
morning. So it's 2
yeah,
hours.
8 hours from you.
Of New York. Good. I have to
So it
tell
looks
you,
like you have a whole crew of people there.
yes, we have about 10 or 12 students online, but after there are about 40 or 50 students that see it offline just immediately. And in this room, we are about 4 or 5, but I suppose that there will more coming in a few time.
Well, I hope they don't embarrass me with hard questions. Those kids are pretty smart these days.
Yes, I had to tell that all this is spontaneous. Larry didn't want to have the questions in advance, so it's a total surprise for him. We have prepared about 14 questions. There were 5 people preparing the questions a long time ago. We have been preparing for 2 weeks. And the thing is that we all enjoy the process. So if you don't want to answer any question or just say, no, I don't want to answer it.
I probably will answer everything. I think it's better that way. It's more exciting that way for the viewers. I might have the bad answers, but they will be what they are.
Good.
You know, our state motto here in Montana is Spanish. The Spanish came into Montana. Our state motto is oro y plata, gold and silver. And the land of the shining mountains came from Spanish coming up here. That's what was the original nickname. So despite being way up north, you wouldn't think we have a Spanish influence here, but we do.
I didn't know about that. So you had to come to Spain. I will
yeah.
show you.
I've always enjoyed Spain. I was shocked to find out that Spain had castles. The first time I went there, I didn't have a clue how many massive castles are in Spain. I was totally shocked. I just wasn't taught that in school. And one of my favorite restaurants is there, Casa Candida. That's a great little restaurant. And was that Seville, I think? Was that? Yeah, we've always enjoyed Spain.
So you know more, maybe Andalusia and all this part of Spain.
Yeah, a little bit. Marbella, that area.
If you come to Spain again, I can show you the Madrid Stock Exchange.
Oh, I'd like to do that.
Because it's a beautiful building in the center of Madrid, and it's just wonderful there.
We went to the Picasso Gallery the last time we were in Madrid.
It's very near the Picasso Gallery.
Yeah,
it's in the same
nice area.
Prado Street, Prado Paseo.
But my Spanish is even worse than my trading. So I don't. It's
no.
I've learned just un poquito.
Good. No, for sure that you know a lot of Spanish.
And surprisingly, when we were in Madrid, we had one of the best steaks of our life at an Argentinian steakhouse restaurant in Madrid. Who would ever think that Argentinians would be in Madrid? But they were there, and it was great. Well, we just froze up.
But
there we go.
They are called many. Oh, my connection seems not to be very good. I'm gonna change the connection.
Okay.
Let me. No, déjale, hay sitio de sobra.
Hombre, en la cámara se me enfoca esto, ¿no?
The students are coming now.
No. En la cámara se me enfoca esto.
Vale. Da igual, da igual. Okay. Can you hear me, Larry?
I can hear you, yes.
Okay. Okay, then we are now about 7 people here and we are gonna start.
Great.
Roberto has not come yet.
The people who have a question.
No, I know. I will start by asking you about the competition that made you famous, the US World Championship with real money. You did a pretty job there, turning $10,000 into 1,100,000. And at the peak, winning up to $2 million there. What can you tell us about your strategies and money management that you used then in 1987? A good year for having a competition with a crash.
Well, my money management strategy was just stupid. I was very, very aggressive, but it's a trading championship. If you want to win a trading championship and set records, you have to do very unusual things. I would never trade managed account money or serious money in that fashion. There's a total difference between trying to win a trading championship or in competition and trying to be a consistently successful trader. So people look at those results and say, oh, they're so fantastic. They want to do that. Yeah, well, I was taking massive risks on each and every trade. And that's why the account went from 10,000 to 2.2 million. And then it dropped down to $750,000. Not many people can handle that. And then we traded it back up to $1.1 million. So, you know, if you're going to have massive gains, you have to have massive risks. And that's really what did it. Fortunately, I had some good trades, but I took on huge amounts of risk.
So you wouldn't repeat this aggressive money management that you did at this time? You wouldn't repeat it?
Not at my age. I'm 81 years old. I don't need to prove anything anymore, you know? So
it was just a question to prove it to yourself that you could do it.
Yeah, I wanted to push it to the max, and we did that. And by the way, that was probably not a good year for people around me. I wasn't a very nice person. I was unpleasant. I was absolutely focused on the markets. That all that mattered, every single little tick on the market. And so I had no life. I don't remember anything in 1987 because it was so into the markets, and not a good way to live.
Good. What products did you trade at this time? It was futures, I guess.
Well, that's an interesting point. I was trading primarily bonds and stock index futures. And then as people saw my results in the account, they said, oh, he's any good. He can just trade bonds and stock indexes. So if you look at the trading record, you'll see suddenly coffee's in there, pork bellies are in there, then cocoa's in there, gold's in there. Because, well, I can do those other markets. It was so brash. And so, but there's some trades like, well, where'd that come from? It was simply to say, look, what I'm doing works in other markets as well, because there was a lot of criticism, oh, he's no good. He's just trading two markets. So I wanted to show that what I was doing worked in other markets as well.
And what strategy did you use? Did you use some of your indicators? It was just guessing, or did you do a mechanical system for that?
Yes. All of the above. Basically, it was a mechanical system based on volatility breakouts in the market, which used to be very effective because remember, in 1987, we had pit session markets. We didn't have the electronic markets yet. So we had an overnight gap to the next morning's opening, and the markets were totally different the way you could trade them then than you can trade them now. So it was a different market. I don't know if we'll ever have that type of an opportunity again. So a lot of what I was doing was based on overnight gaps, and then the extension from that gap in the morning up or down. And so it was mechanical, but obviously with some intuition. And, I'd get scared like anybody does. And sometimes I took profits too early, sometimes too late. I mean, that's the life of a trader. It's a very imperfect business.
So you were learning at this time
I'm still learning. So this is
how
a
to
learning
trade.
experience till the day you die.
But you're still learning. That's a good thing. That's a good thing to hear. I know you are a fan of cyclical analysis. You are a member of the Foundation for the Study of Cycles.
No, I'm not.
You are not a member.
No, I'm not a member.
I thought you were because you have done a lot of conferences for them.
I've done some conferences, but I'm not a member. I think for a couple of reasons. One, I use different software than they use. They probably don't like to see that. And
Okay.
I'm afraid of joining any membership that would accept somebody like me. You have to wonder about them. So I'm just kind of I'm not a member of much of anything.
Okay, that's good. I'm not a member also. But I like this type of analysis, the cyclical analysis. What do you think about the cyclical analysis?
Well, it's the great mystery to me. When I first started trading in 1962, I really thought that it was all about cycles, and on a long-term basis, of course. And then I got very involved into conditional markets and trading. And clearly that worked. We made a lot of students won trading championships following my material as well. So we know that worked. We've proven that. In the last 2 years, I've gotten way back into cycles again, because I think on a longer term basis, things happen cyclically. Like right now, we're in a bull market. We're going to stay in a bull market in 2025. The cycles are ripe now for rallies in the market. So cycles give you really good long-term perspective. They don't call the day-to-day action all that well, but in terms of long-term perspective, yeah, and that's what a trader needs. You need a bias. Should I be long or short here? And what can give you that? Well, a lot of things, but in my case, what I found is cycles are really good to get me on a roadmap, a path, saying, yeah, I believe we're going to go higher, so I can trade the market accordingly.
No, yes, that's very good. Because if you have a roadmap of the market, it's a good advantage of it.
Huge advantage.
Huge advantage. And I want to know, because I'm curious, I'm a fan of W.D. Gann, and I would like to ask you about the father of this cyclical analysis, that is Gann. What do you think about him? I think that you have researched about him, and I would like to know your opinion.
Of who? I didn't hear the name.
Gann, W.
Oh, Gann. Oh, yeah, I got an opinion of Gann. I know, everybody has an opinion. I met his son. I knew his son. So there's a lot of stories about Gann that simply are promotion. I knew his promotional his PR guy, FB Thatcher. When I was a young kid, FB and I wrote, I don't know, maybe 100 letters back and forth to each other. So I have a little different perspective on Gann. I think he was a hell of a good promoter. And he had charts when a lot of people didn't have charts. He had some good calls in the markets. He had some horrible calls in the markets as well. But above all, he was a great promoter. So now everybody's trying to make a mystery out of Gann, and everybody has the answer to Gann. Well, he was a trader. He didn't end up with hundreds of millions of dollars. We know that from factual research. So yeah, he was another character in the marketplace. He had some contributions, but to think that it's the be all end all of analysis in the market, I don't think so. But all the Gann people are going to disagree with me. But most of the Gann people are selling Gann systems and strategies, and I don't see them really trading. I really trade. I'll show my real trades. I still trade. I'm an old man. I still trade. So there's some stuff to learn from Gann, but don't, as Ronald Reagan said, trust but verify. So let's verify this stuff before you start using it.
Okay, thank you. Do you know of a timeless strategy in the market? A timeless that always works, always is working, always is working.
Yeah, sure. Whenever the public's long, buy, or whenever they're long, sell. When they're short, buy. Clearly, sentiment indicators, and there's some humor in that, but my friend Marty Zweig, who passed away a few years ago, was a very academic guy. and showed that one of the most reliable, probably the most reliable, I think he said, indicators is sentiment. You wanted to go the opposite of the crowd. When everybody's really bearish, you want to be bullish, and vice versa. So, and that's not going to change. You can bring in artificial intelligence, neural networks, whatever you want to bring. That's not going to change. The public doesn't get this business right. Never have, never will.
Good. So all sentiment, and how do you measure the sentiment of the market?
Well, there's a lot of, it's easy now. All you have to do is watch television. You know, all these talking heads on TV probably just add up, oh, this guy's bullish, bullish, bullish. You could do that. We have a measurement of newsletter bullishness in the marketplace. The idea originally was happened with a service called Market Vein many years ago, where they'd add up how many weekly newsletters were bullish or bearish. And that similar ideas worked real well. Just ask how many people are bullish or bearish here. And we do that on a weekly basis. A really good indicator. I first wrote about it in a book for Bloomberg in 2000. So here we are 23 years later, and it's still a really good indicator. So yeah, sentiment's one of the backbones of understanding how the markets work.
Good. If you could only trade one algorithm system, either yours or another author's, which one will you trade on which assets?
If I can only trade one system?
Yes, only you are allowed to use one system. You have created many systems.
I wouldn't try. Yeah, people have that wrong. I'm not a system trader.
Yes.
I develop systems, but let me explain that. It's a really an epiphany in my life. I was having dinner with my good friend Tom DeMark and Steve Cohen. Steve's worth, I don't know, $40 billion, manages, I don't know, who knows how much money he manages, at his house. And I started as an art major. I don't have a background in economics. I have a background in math. I don't know anything about business. And I looked on the wall next to me was a Van Gogh original that Steve owns that was in my art books as an art student. I go, whoa, he owns that painting. He's not a mechanical trader. I'm a mechanical trader. Not anymore, because this guy's done phenomenal with judgment. And the problem with systems is they say the future will be like the past, always. And we know that's not true. It can't adapt for the future. So years ago, I switched from being a systematic rigid trader to saying, you know, the good Lord gave me some intelligence, not as much as I'd like to have, but I think I can use that. And to be a discretionary trader, you make more money. If you look at the mutual fund performance, commodity funds, the ones that are discretionary traders, Paul Tudor Jones, Cohen, all the great ones, they're not mechanical traders. The mechanical traders will make money, but they don't have outsized results. So to me, discretionary trading is where the really big money is in this business.
Yes, we'll come back to this point later. But now, which markets do you consider to be the most predictable and easy to trade? And why?
Well, the most predictable market ever was the egg market. We used to trade eggs here because just before Easter every year, eggs rallied because everybody bought Easter eggs. Well, we don't have that market anymore. I don't know that any is more predictable than another, but I think the easiest markets to trade would be gold. It's very reliable. It's not driven by inflation. It's not driven by the economy. It's driven by actual supply demand. So gold is a really good market to trade. I'm short a lot of gold right here. The bond market is a good market, long-term, a lot of data, a lot of institutions in the market, doesn't get too crazy. The stock index futures, probably crude oil, and maybe one of the grains simply because they're not very active compared to the other markets. So those are the markets that I really focus my attention on.
Okay, what do you think about cryptocurrencies and crypto assets?
You know, the currencies have never intrigued me. I didn't grow up with them. They were kind of came later in my trading life. My only interest in the currencies is the euro currency or the dollar index, and they're just the reverse of each other. If you're long dollar, you're short euro currency. The other currency I am attracted to is the Japanese yen. Has a lot of liquidity, a lot of volatility to it. So of all the currencies, That's all I focus on. I can get into plenty of trouble in those three markets. So why get into all the other ones?
And no way for Bitcoin or cryptocurrencies, right?
Yeah, I'm right with Warren Buffett. I don't, I'm an old man. I don't get it. The Bitcoin people are saying this, hey, Bitcoin's a great deal. Tell you what, give me your dollars and I'll give you some Bitcoin. I go, well, wait a minute. They want my dollars, right?
Yeah.
They're going to give me Bitcoin and take my dollars. Like, well, that doesn't make any sense to me. They want my dollars more than they want their Bitcoin. So is Bitcoin going to change the world? I don't know. Probably not in my lifetime. And I hope to live to be a really, really old man. So to me, it's a great speculative market. If you want to be a wild speculator, you don't have a lot of fundamentals to trade on. Yeah, it's a great trading vehicle. But in terms of something that's going to last forever, it's not going to instantly fall apart like it did. I don't have to have markets that have that potential exposure to them. So for me, I'm just another crotchety old man that doesn't understand Bitcoin.
Mhm. What are your thoughts on the impact of psychology on trading?
Well, my thoughts have changed on that. My son, Dr. Jason Williams, is a psychiatrist trained at Johns Hopkins. And Jason did a lot of clinical research on just successful traders. Prior to Jason's work, people had just looked at losing traders. So Jason studied highly successful traders, wrote a book about it, The Mental Edge in Trading, published by McGraw-Hill. And there were like 3 or 4 or 5 points that came out of that book. That a couple are really surprising. One was all these really successful traders. I'm talking about people who made hundreds of $1 million or more trading. We're really good with details. Number one, good with details. Here's a surprising one. Number two, they had a low self-image. You can measure a self-image scale, and their self-image wasn't real low, but it wasn't off the charts. These guys were worth billions of dollars, hundreds of millions of dollars, and their self-image was not all that high. And we reflected on that. So that's really interesting. And it hit me like, well, yeah. Because if your self-image is a little low, you don't plunge, you don't over risk, you're more careful, more cautious. The traders I've seen that have consistently blown up are the yellers, shouters. Look what I did. I made $1 million here. I made $5 million there. They're going to blow up. These highly successful traders, and I've known almost all of them, they're pretty low-key guys. They're not going to, oh yeah, I did this, I did that. So that's the second thing. The third thing that's really important is that their emotions don't swing real high, real low. You know, if somebody came in and said, Larry, you're ugly, you're stupid, I might want to punch them in the nose. These guys say, yeah, I probably am. You know, their emotions, they can live with wives that are the wives from hell and it doesn't bother them. Anybody else would have shot their wife by then. But that's their emotions. Don't yo-yo back and forth. They've just a little bit. And I think that's the third thing that really makes them really, really successful traders.
Good. About the measures implemented by the Fed in the market since 2008, do you think that it has influenced the behavior of financial markets?
Yes and no. So I can explain it this way. My perspective now is the markets are cosmic, that the markets are going to rally right now for cyclical, cosmic, whatever reasons. Because of that, the Fed will come in and lower inflation now. Because of what we saw in 2008, that was a great cyclical time to buy. So something had to happen to make that take place. So the Fed came in and we increased money supply and lowered interest rates. So yeah, they're part of the process. But again, if my view is correct, on a long-term basis, there's a cycle that's going to have prices go up or go down. And then the Fed just does what they have to do at that time. They're in the same cycle too. That's my working theory. It might be a wrong theory, by the way. I've been wrong a lot in my life, but that's kind of my working theory. These things happen because it's supposed to happen. It got almost like predestiny. Like, right, we're predestined to rally until 2025. So sure, the Fed's going to do whatever is going to accommodate that long-term cyclical aspect.
Yes, but the market wouldn't change. The market will do whatever it has to do.
Yeah, and I could be wrong on this. I'm really arguing with myself on it. Can the market be that predestined? And if you look at books that were written in the early 1910s, 1911s, where they talk about long-term cycles in the market,
Yeah.
and those exact same cycles are still very effective today, that's what makes me think there's some cosmic thing going on here. I don't fully understand it, obviously, but there is something beyond our normal understanding of the markets.
Yes, there must be something going on that we
Yeah,
don't
there's
control.
and it's in the heart and soul of mankind. We all get bullish or bearish. We go from wars to no wars. We go from radical politicians to liberal politicians. There's these cycles in life. And maybe it's influenced by weather, barometric pressure. Some people have argued. Some people say lunar, some solar. Whatever these things are, they cause people to do things. And when people do things, stock prices go up or down. That's not real helpful to a new trader. I realize that. But it's my longer term perspective that, yeah, these things are going to happen. There's not much we can do about it. Prices go from here to here for real reasons. It might be fundamental reasons. Could be this cosmic thing I'm trying to work out in my mind. But they go like this because of emotions, news and stuff of the day. They go crazy, but they're going to go from here to here because of some reasons, some fundamental conditions that we're still trying to work out.
Good. What time frames do you usually trade? Lower time frames, large time frames?
Yeah, that's really a great question, by the way. My time frames, 3 to maybe 25 days, something like that. Though I've been in an S&P position for a lot longer than that, since the lows last October, right at the low. And I'll hold on to that as long as I possibly can. But generally speaking, 3 to 25 days. And here's why, and this is so critical. This is the whole secret of trading. I want to wrap it up for you in a nutshell here. It's this. Trend is the basis of all profits. If you don't have any trend, it doesn't matter if it's real estate or stocks or commodities, you're not going to profit. You've got to have a movement this way or a movement that way. For the movement this way, nobody can make any money. So we ask ourselves, we have to have trend to make profit. So what is trend a function of? Trend is a function of time.
Mm-hmm.
The more time in a trade, the bigger trend you can catch. So a day trader has 3 or 4 hours to catch a trend. I have all year to catch a trend, or maybe 25 days to catch a trend. So I have a better opportunity of catching a large trend than a day trader who's limited to just a few hours. And then what that really gets back to is this. If I can catch a large trend, I can have a small position and make a lot of money on a big trend. Little position and ride a big trend. A day trader, to make a lot of money day trading, since his time frame is so short, has to have a big position because the trend is so short. And if you have a big position, you're going to get stopped out with big losses. And you'll probably let those losses become bigger than they should become because of the emotions of having a large position on. So the basic mathematics favor a trend person whose time frame is longer than a couple of days. If 5, 10, 15 days, you can capture some huge moves in these markets with a small bet, make a lot of money, which a day trader cannot do. It's impossible to do that.
Right, you are right. So now I have a question, a long question about money management, prepared by one of our students, that say something like this. Most money management algorithms increase size when equity reaches a new high after a sequence of wins. But that seems to be the worst moment to increase size because a loss is probably coming and we are going to take it with bigger size. Has you noticed this effect and thought about how to manage this? Like delaying the moment when you increase size or similar? Any recommendations about this from your experience?
Well, mathematically, I know that you have to increase after you've made more money in your account, you're not increasing the percentage of your account that you're wagering in the market. You may have more contract, but you're still risking 2% or 5% or whatever you think the magic number is. So your risk isn't any greater. I acknowledge your student is correct. If you're in a string of winning trades, eventually you're going to have a losing trade and you're going to get tagged. However, I've seen strings of winning trades from 6 to 18 winning trades in a row. So are we going to step out and bypass all these? I think not. I know mathematically, and Ralph Vince has written the best books on that. Anybody wants to delve into really money management, read Ralph Vince's books. Clearly, that's what math tells us we have to do. I will disagree to an extent with the side that says, well, as we lose money, then we must decrease our risk. I mathematically understand that. But as a trader who has some confidence in his ability, I'll say, yeah, I'll cut back a little bit here, but not too much and not way much, because I'm going to come back. I've been doing this 62 years now. I've been through ups and downs. I've lost a lot of money. I've had huge losing streaks and winning streaks, but I know I'm going to come back. So I'm not going to cut back as quickly as the mathematical formulas would suggest, because I have confidence in myself. I'll cut back, but not as rapidly as a mechanical formula would do.
Good. I have a question from the audience. JPN asked, what do you think of Tom Denmark indicators that you mentioned before? Denmark. Tom
Denmark. Well,
Right.
Tom's been my best market friend and buddy for 50 years, maybe. We developed sequential together, triangulation, propulsion. We did a lot of systems together. The backstory is it's interesting. When Tom and I developed those things, he lived in Racine, Wisconsin. I lived in Kalispell, Montana. We did it all over the telephone. We did not have computers back then. And even more interesting, like I said, my background is art, and I have a degree in journalism. Tom's background wasn't in the markets at all. We didn't go to Wharton, we didn't go to Harvard or Yale, or you didn't work for Goldman Sachs. So anybody can do this stuff if you just put enough time on it. You don't need a lot of fancy stuff. But what Tom and I did, we looked at charts. We really got into minutia. So there's a parallel there that you don't have to go to Wharton to be good at this business. And if you just study the markets, you're going to learn a lot. What Tom has learned, what we put together with sequential, is trying to develop waves, Elliott wave. Well, what's a wave? How do we define a wave? And so we could define a wave in the market as 4 consecutive closes greater than 9 days ago, closed 9 days, or 9 days closing greater than 4 days ago. Those are waves in the market, really identify as a wave. Then we stumbled into that. We found that you could get a bunch of waves and ultimately get a top with a sequence of closes greater than a high 2 days ago. So Tom has really broken out the code of the market, how it moves in terms of waves, and he's taken it now with sequential combo. So pretty good. I mean, Tom's had some amazing calls. The absolute high of a market, absolute low day of a market. So not always, because this is an imperfect business, but yeah, Tom's had some incredible calls in the market.
Mm-hmm. Good. Let's go back to the original question that starts this interview, that is that you now don't believe in algorithmic trading. And why don't you believe in algorithmic trading? You said that you have a cathartic moment some years ago. Tell us about all of this.
Well, Winston Churchill said it best. Winston Churchill said it's great to have a strategy and a system, but occasionally one should look at the results. And I think he's really right. Like, I look at the results. I see people that are not systematic traders, and their results are far greater than people that are systematic traders. Years ago, I put a lot of money in developing neural networks and AI, artificial intelligence strategies. A lot of research money into that. In today's terms, maybe $500,000, maybe more. We developed
Mm.
strategies with them and they blew up. They didn't make any money. So again, we think that we can understand the past perfectly with a strategy, but the future is not quite like the past. It's always different. And we can't adapt. Your symptoms, I've got to do this, despite the fact that things have changed now. So yeah, strategies can make money. It's a lazy man's way of making money. Put in my computer, go to sleep, wake up. Well, how did I do today? Go back to sleep. That's a lazy man's strategy. And a lazy man's strategy gets lazy man's results. I want to maximize my opportunities in the market. That's why I'm a systematic trader.
So you are a judgmental trader that you said to me, and I don't know really what you mean by judgmental trader. It's like George Soros kind of trader, or what it is?
Yeah, I call myself a conditional trader. I'm looking for conditions that our research shows in the past have usually been present when we have large up or down moves. So my first thing is, are the conditions right? And everybody else in this business goes like, oh, what's a buy signal? There's a buy, there's a sell. I'm not looking for a buy or sell. That's a long ways away. I want the conditions to be there for an up or down move in the market. Then after I find the conditions, I want to have that, I want to bring something else in to confirm those conditions. Then I'm going to look for a trend change or a buy sell signal. And of course, using money management, and then my exits and entries. But it's so much fun to trade. Most people just want to go buy, sell, buy, sell. They have no idea of perspective. What's the condition they're in now? Are we bullish or bearish condition? They just want to buy signal and sell. They want to make money today. I don't care really about making money today. I care about finding great opportunities in the market. And technical analysis, in my opinion, is not good for finding great opportunities. It's great for timing an entry in the marketplace. Charts don't move the markets. They're a reflection of what the markets have done. They're a reflection of emotions. Charts don't cause the markets to move. So you have to understand, your people think charts are magic. There's no magic to them. They're a reflection of the past. We can learn from that, but you got to understand the conditions. If we're in a high inflationary economy, interest rates will be one way, low another way. Charts don't know that. So I'm really big into conditions to set up a trade, then bring in technical analysis. Like gold right now is a good example. The conditions have been very ripe to sell gold and silver. Commitment traders, the large traders have been selling this market. The public got crazily bullish up here at the high sentiment, right? We were talking about that earlier. The public's really bullish. It's usually this time of the year, gold goes down at this time of the year. There's been distribution of the gold market if you look at accumulation distribution. So yeah, the conditions are there. When will it go down? Who knows for sure? That's where you bring in technical analysis.
Yes. I have here next to me to the responsible of being here. He is Roberto Marcos. I introduce
Nice to
you.
see you again.
My pleasure.
Charlie.
Thank you.
He gave me your email, so I contacted you for RoboTrader competition. And he has a long question for you that is number 8, that I skip it just for him to ask.
Yes. Okay. I will ask the question. When applying your well now profitable first opening exit technique, what design methods or procedures do you use to ensure that an exit with a hit rate does not mask the entry with no predictive power?
So a tough question.
Well, I think I understand the question, but I don't.
It's about your first opening exit technique. I don't really know what was
the
the
first
technique.
I'll explain it to you.
Profitable opening.
Tell me if I explain this right. Maybe I don't. Okay. If I'm in a trade,
You should know.
if I'm in a trade as a short-term trader, very short-term trader, and I will exit on the first time the open is profitable to my position. That
Yes.
doesn't mean I exit the next day. I might buy today at 3 and it opens tomorrow at 2, and open the next day at 2, and then it opens at 3. I still don't have any problem. Then it opens at 5. Then I would be getting out on the first profitable opening. It's a very, very good and excellent short-term exit technique. But
Yes.
again, you're limiting the time or the trend in the trade. So it's not for long term. It can be used for long term, but that's another story. But it's a very good short-term short-term exit technique.
Yes.
Good.
But I know several people that use your technique for exit from a trade, but he uses near random entry without predictive power, and your exit is very wonderful and mask the trade without predictive power. It is masked with the exit, and in the future the exit makes his work, but the trade not have an edge in the market. Do you understand this
Yeah,
situation?
I think so. I've had people tell me that just using that exit technique with a random entry, you could actually have a relatively profitable system. Not a lot, but you know, it stands up to a test. So we know it's a good exit technique. It's a little different now in the pit session because we don't have pit session markets. So I close and then we open 2 hours later. So the first profitable opening, you might want to delay it a day. And that's what we actually do now. Say, well, let's wait 1 day and then we'll look for the first profitable opening. That gives us more time, more trend to be in the trade. You could use it on a longer term basis. So say the first time on a weekly basis, I have a profitable opening on a longer term strategy. You could use it that way. Some people have done that. But in terms of a strategy, short-term strategy, it tests out well. Here's a real simple system. You're gonna love this one. You want to trade the S&Ps, right? You're going to buy on even days. So if today is the 12th, we're going to buy on the 12th and then exit on the first profitable opening. Don't buy on odd days. So if it's the 13th, you wouldn't be a buyer on the 13th. It can't get more simple than that. Not a bad strat. Doesn't make a lot of money, but if you want something that's really mechanical, that's really mechanical, and it does okay. It holds its own at least. So what I found, especially in my own trading, I don't get out soon enough. I've left a lot of money on the table in my trades.
I know.
Yeah, and so you have to have something that says, you idiot, get out of here, grab your profits and run. And so for that purpose, the first profitable opening exit technique is pretty good.
Yes. Thank you, Larry.
Okay, I have a question that maybe don't apply to you, but I'm gonna ask you anyway. Every trader has either gone bankrupt at some point or gone through a really tough time where they were on the verge of losing everything. How was that moment in your case? Maybe you, you never had.
Which time you want me to talk about? And that's been a huge change in trading. When I got into this business in the 1960s, nobody understood money management. And if you look back, and I love the history of the markets, and really much of an historian, all the commodity funds, Dick Dungeon, a friend of mine, did the first commodity fund ever. And he would boom and bust. He'd raise a lot of money, make money, poof, they didn't blow it up. Raise a lot of money, make money, blow it up. Finally, Paul Tudor Jones came along with Peter Borsch, and they put together a fund, and it didn't bust. Why? Because they're great traders? Yeah, partially, but why? They use money management. Since I learned the key to money management, I haven't had the boom bust cycle in my life. So I haven't had that cycle for, I don't know, 40 years now. That's a long time. But originally I was like, hey, bet everything in every trade, lose, make money. It was a whole lot of fun. Well, why is this happening? It was money management. So, but to get back to so that's why we don't see boom bust often anymore. But Yeah, I've had some horrible times in my life in terms of trading, when I was young, especially. And so how do you endure those things, right? Some people don't. They just walk away and, you know, buy a bottle of wine and try to forget their miseries. My passion for this business was so great that I actually saw my losing experiences as a wonderful opportunity to learn. Like, I really did something wrong here. I blew it. Not the market, it was me. What did I do wrong? Well, quickly see it was money management was one thing. I still see that. Another thing is like, well, I rushed a trade, whatever. It makes you investigate the past so you become better in the future. So most people see those big blowups in the market as a horrible thing, and they fear them and they walk away from them and they lose their confidence. The most important thing I can have in this business is not money, but confidence to risk some money. And I never lost my confidence. Maybe I'm just, you know, too dumb to lose my confidence. I don't know. But I know it doesn't. I see a lot of really smart people lose a lot of money in this business because they're too smart, and they overanalyze this stuff. So I think not being real smart helps, and just having confidence. Like, my life's going to work out. I mean, God's prevailed. Whatever has happened, I've been in a lot of bad things in my life. It's all worked out. I'm not going to worry about the future. So that attitude and the attitude of losing trades are really wonderful, because I'm going to learn from those trades.
Good. Let's pass to questions from the audience. Let's start. Nestor has a very long question here in the chat. Maybe, Nestor, you could ask yourself. You can open the microphone and ask Larry. He told you that thank you very much for sharing this moment with us. And he wanted to share a story in the epic of Mahabharata. Nestor, are you there, and can you tell us the story? Well,
we're waiting for them or for me. I'm confused.
No, for him. For
yes, I'm here. Larry.
Okay, so
Larry, thank you very much.
I can hear somebody. Yes.
Okay. Additionally, I would like to share the following with you. In the epic of Mahabharata, Yudhishthira was a king Hindu who lost his kingdoms, his brothers, his wife, even himself in the game of dice. He was exiled with his family, and from the exile, he mastered the game of the dice. To become the best during his time in exile, he also prepared for the war to reclaim his kingdoms, which he immediately achieved, not through the game to dice, but through another means. What do you think? What do you identify with this king?
So
that's
the message,
broken up. Yeah. Can you? Thank you.
The message is, if you identify with the king that loses everything eventually, but at the end he knew how to play the game of dice. But I think this is a tough question.
Well, I think I understood part of it. Somebody lost everything, right?
I suppose so. Yes.
Yeah. Well, that's their fault.
I
Not the
think,
market. It's not the markets. It's if I lose money, if I blow up, it's not the market's fault or God's fault or anybody else's. Mine. I did something wrong. I was stupid. So you just don't be stupid.
Uh-huh.
I think
But
this,
we always want to blame it on, oh, it was the Federal Reserve, it was the government, it was the Russians. It's always the Russians, right? No, it isn't. It's you. If I screw it up, if I lose money, it's nobody's fault but mine. So I have to. What I do wrong? It's me. If you can't have that attitude, you shouldn't be in this business at all.
I think this story is represent the professional of any trader, because exists another way to win the war. The war that not means the war in the war. Also, the war is the life. Okay, win in the life, not in the trading. I hope that you understand.
I repeat that for me if you would, because it's very broken up when he comes in my headset.
I
No. Don't you repeat it. Let Eduardo tell me.
Can you help me, Edward, please?
I can't, Ness, I can't understand you in my headset. So let Eduardo explain.
So Nestor is, yeah, I can pass to another question, and at the end maybe we can start again with the question.
I have one question more.
Roberto
Yes.
has a question.
Hi, Larry. I have another question for you. In the past, several years ago, I see in a forum how is your portfolio in the trading Robins competition, and I see several interesting things in your trading. I see that you use coffee mixed with S&P and mixed with bonds, especially with bonds. I think you win the contest. Can you explain why do you use this kind of assets to trade in the competitions?
Sure. It's the joy of trading the bond market is it's relatively stable. It has huge volume. So I can buy 1,000 shares, 1,000 contracts, boom, like that. Especially now electronically. The market's a lot easier to trade now electronically than they ever were with the pit session. When we had the pit sessions, if I wanted to buy 1,000 or 2,000 bonds, I would call my order to the floor. And because remember, the pit's a circle, I would have orders here and orders here. My guys are competing with each other. So I had an order here, and a filler over here. So they're looking at different places in the pit to work off my orders. That's how extreme it was. Now I go click, I'm filled on 1,000 bonds. It's like, boom, it's done. So it's so much easier to trade now. The bonds, gold, bonds, S&Ps, they have liquidity, they have huge volume in them. So I can sneak in, sneak out, nobody knows it. But if I try to get in, I'm in sugar right now, very small position. I have 10 contracts. That's a big amount for the sugar market. Couldn't have a real big volume, short sugar, by the way. So yeah, I want to be in the deep end of the swimming pool where I can splash around. I don't want to be in a thin market. I was in propane one time, and propane went limit down. I forget. I think 13 days in a row, limit down. I couldn't get out. How much the money do I lose today? Lose. 13 trades. I was like, what did I do wrong? You idiot, Williams, you stupid guy. What did you do wrong? Well, I bought when I should have sold, but I couldn't get out. Why couldn't I get out? Because the market was only trading like 100 contracts a day. Thin market. I don't trade no thin markets no more.
Yes. Thank you, Larry. Thank you.
Can you recommend us a book where you can see your methodology reflected or something like that?
But your methodology now, because you say you're a manual trader, 3 books you say are more likely your methodology now.
Well, let's talk about books. I think a couple books you've got to read. One is Confessions of a Stock Market Operator by Edward Lefebvre. That's the story of Jesse Livermore. Also, the other book I love is called Zurich Axioms. Zurich, like the town in Switzerland. Axioms, AXOIMS by Max Gunther. It's a wonderful read, very well written, a lot of wisdom. It's not going to say buy bonds tomorrow, but it's going to give you an understanding of the marketplace and players in the marketplace and about charts as well. It's interesting comments he has there called the chartist fallacy. In terms of my books, for what we're talking about today, you probably go all the way back to the first book I wrote about commodities How I Made $1 Million Last Year Trading Commodities, because that book really is fundamental in nature, looking at the commitment trade report, looking at signals, looking at conditions. That would be one book, and maybe my book about the commitment to trader report, Trading with the Insiders, would be another one to read. Or just replay the video. You don't have to go buy a book. Oh, by the way, I found you can usually get my books, usually, not always, cheaper on Amazon than you can at not on Amazon, on eBay. Usually, but not always. Sometimes they're really expensive on eBay. So, but look at eBay if you're trying to buy the books cheap.
Okay, thanks.
Larry, one more question. And the last, I think.
No.
I remember that you use a platform called Trade Navigator. Do you continue using this platform to make algos?
No, I had the True to Sue Trade Navigator. We got a judgment of a couple $1 million against them. And so we have parted our ways. They were doing a lot of stuff with my material, and the jury rules in our favor on that. So no, I don't use TradeStation, Trade Navigator, or Genesis at all. We won the lawsuit, and they had to pay us. I do use TradeStation.
Yes. I use TradeStation, but I see in all material that you use this platform, and I want to ask to you, is you
Still use it?
No, I don't use Trade Navigator anymore. I use TradeStation. We use NinjaTrader. We use Bloomberg. Where else? And my material is a couple other softwares, but not in Genesis. Anything in Genesis or Trade Navigator is not mine. That's what the lawsuit was about. So no, I'm not involved with them in any way whatsoever anymore. Yeah, I originally, in some of my old books, I use the Trade Navigator stuff. Absolutely, yes. But since the lawsuit, the judgment came way heavily in our favor. It took the jury like 30 minutes, 40 minutes to decide. And so we parted away with Glenn Larson, Trade Navigator, and Genesis.
Larry, I remember in a past webinar several years ago that you say that bankruptcy is bullish. Can you explain this?
I didn't hear that. That what is bullish?
Bankruptcy, bancarrota.
Yes, bankruptcy.
Bankruptcy is bullish.
When the bank goes down.
Yes.
I said that. I don't know what I said. I said so many things in the last 61 years, 62 years, whatever. I don't. But it could be. I mean, are you talking about a corporation or for yourself?
Yeah. I have a lot of.
It's good in that it's cathartic. It's the end of the bad stuff, and maybe you can get good stuff going again. So that would be kind of a cosmic comment. Yeah, it's over. Now you can restart.
Yes.
Yes, now in the US, especially in the US, banks go under, and it's a difficult situation.
But they come back because somebody else. Banks don't really close. They close the bank for a little bit, and then another bank takes over the bank. You know, the big fear now is, are we going to have a bank failure in the United States? No, that never has happened. Are we going to have the Congress now is working with the debt limit? Are we going to raise the debt limit? There's all this bearish about the debt limit. Come on, get out of here. You think America's going to default on its debt? No way. Come on, dude. Duh, it ain't going to happen. So this will get resolved, and the debt ceiling will be increased, because we're not. That's a huge point here. You got to start to look at modern monetary theory. It was a real wake-up call for me. I always saw the world as being the dollar being backed by gold, and it isn't any longer. It hasn't been for a long, long time, since 1973. We are in a different fiat currency, and a fiat currency, the economy does not operate as it does when it's backed by a hard asset, whether it's gold, wheat, whatever, doesn't matter. But we are in a fiat currency. So the debt ceiling being big, having a deficit, it doesn't mean what it used to mean. And my fear of that was a huge fear of it. way against deficits. Now they don't bother me at all. In fact, if you look at the economic data, the bigger the deficits, the more the stock market rallies. That's real clear. That's just not my view. It's in the data. Now, why is that? Because if we have a big deficit, we have more money in circulation, more money out there building bridges, buying stuff, bribing government officials, whatever. There's more money. So large deficits are bullish. They're not bearish. And that's only have the last 60 years of proof of that. So, you know, I see some things a lot different than most people.
Thank you, Larry.
60 years is a long time, yes.
Long time. Yeah. I mean, I'm so blessed to still be alive and be in good physical health and stuff and trading in markets. And yeah, it's been a great career. I just, you know, I couldn't be happier with my life.
That's fantastic. The career that you have is fantastic.
Larry, do you have planned to write another book?
I have plans in my head for 2 books, but my fingers, you know, look at them. I have a little arthritis in them. I never did learn to type, by the way. So I have to do this to type. And I've been working on a book on cycles. I don't know if it'll ever come out or not. And I've been working on a book on a Native American Indian prophet called Wavoka that started something called the ghost dance. And I've collected ghost dance items and fascinated. So I've worked on that a little bit. I work in my cycle book, but boy, that's a labor of love because it's like one letter at a time. So I don't know if I'm working on it, but you don't hold your breath. Okay.
Yes, you write it by cycles every morning.
Yeah, I got one of those things where you can
And then
dictate,
stop.
and that didn't work anymore. Yeah, so the idea is there. I have maybe 3 chapters of the book.
I would love to see this book, but
Well,
yes,
thank you for the encouragement. Maybe I'll keep working on it then. Thank you.
yes, you have to work on it.
Larry, if you come to Spain, please don't forget to visit us. I have several books to give you to get your sign in your books.
I would look forward to that. I think we're going to go to the Olympics in Paris this coming year. So maybe we'll drop down to Spain. We'll let you know.
Yes, sure. That would be great. And I don't know, we have many people here. I don't know if anybody wants to ask Larry a question.
One more. I have a lot of questions for Larry. Larry, do you trade the spreads?
Do I trade spreads? No, I'm not smart
Yes.
enough. It's
No.
over my head. I have enough problem figuring out if one market's going to go up or down, let alone look at 2. So I'm not a spread trader, no.
Okay.
Say gold, SP,
Yes.
kind of things.
Thank you, Larry.
So you are short now gold, I guess, from
I'm
your
short gold,
silver.
short silver, long unleaded gasoline, short sugar, and long the bull market.
Okay.
Or futures, right?
Or
Yes,
future.
yeah, right.
Okay.
That's good.
How many contracts? 1, 2.
No.
You want to know how many? You want to know how many? I'll tell you how many. On the winning positions, not enough. On the losing positions, too much.
That's a good answer.
Okay. Thank you, Larry.
Very good.
Thank you, guys.
I would like to ask you a question, but maybe it's too personal.
Go ahead.
Because
I don't have to answer it.
I have a daughter that wants to be an actress, but wants to be a millionaire. And I said that she should trade. I know that you have a daughter that is an actress, so it's a coincidence. What would be your recommendation to me to tell her?
Well, I think what you need to tell her is you have to find what you're good at and enjoy. And then do that and enjoy it. See, there's a guy named Tony Robbins. Tony says, find your passion and you'll be successful. That's only half correct. My passion as a young guy, I want to play professional football. I was really passionate about it. I had no ability to do it. I didn't have the body. It wasn't fast. Wasn't smart enough. So my passion was there, but I didn't have the skill. They didn't have the natural abilities to do it. So you got to find something you're good at and you're passionate about. So maybe that's acting, or it's being a plumber or a carpenter or a cowboy or whatever. But you got to find something that you just like, wow, I love this stuff. And you're good at it. You have to have that combination, because just one or the other, you might be really good at something, but if you're not passionate about it, you give up on it. So something you're good at and you're passionate about.
Good. Any other question?
I have one. If I
Okay, Jaime have one. Come here. The room.
Harry, hello. Well, first,
Hello.
say it's a huge privilege to be able to talk to you. So thank you very much.
That's my honor. Thank you.
You say that that nowadays you find you like more to trade on opportunities, on context, let's say when the moment it is, and then try to take a long trend of many days. But at the same time, we treat like something systematic the seasonability, and that is how it sounds. How it sounds what you say. So would it be, in your opinion, maybe the seasonality is what you think that out of the systematic, or let's call it somehow algorithmic or mathematical way of studying the markets, what can be more similar to cycles that you have been talking about, and then use that to find those opportunities for some systems to work?
Do you remember when you were maybe younger and you had a lock, and we call those a combination lock, where you have to go this way to get a 6 and that way to 13 and that way 15, and then it unlocks, right? Well, that's the market. You have to go this way to see what seasonal is doing, this way to go what cycles are doing, this way to see what commercials are doing, this way to see what accumulation is doing. Then the market unlocks itself to you. So to look at just seasonals or just this or just that is nice, but it doesn't unlock the lock. You've got to click off all those little points there. So they're all good tools, but on their own, I wouldn't trust any of them. So I want to get a culmination of a lot of stuff going there. If I'm going to risk money, why not try to get as much good stuff there as I possibly can?
Thank you very much.
Mhm.
I have one question. Larry, do you think your manual strategy could be done like a manual program? Excuse me, like a program strategy? Can you see your manual strategy?
Eduardo, I can't hear that. Eduardo, kind of.
Yes,
Yeah, thank you.
Yeah, I will tell you. He's asking if your manual strategy, that your judgmental strategy, can be played by a machine, by a
Oh yeah.
algorithmic.
Converted to train system,
Sure.
algorithmic train system.
I don't think so, but you
Yeah,
can.
we have
you can-
several strategies that are automatic. The computer just buys and sells. And they'll do okay, but they don't make massive amounts of money. They don't optimize the potential to make money because it's a mechanical trading strategy.
Yes. Okay.
Guys, I got to get back to the
Yes.
markets.
So.
I got stuff to do. And besides, it's almost your bedtime. What is it? 7 o'clock in Spain?
It's 7 o'clock. Yes.
Oh,
I
is that
think
what-
it's time to have a beer here.
Time for dinner for you at least. Yeah.
No, dinner
well,
would be at 10 or something.
oh
like
my
that.
gosh, I can't. I know, and I go to bed by 9 o'clock is a late night for me. But I have markets open early in the morning. How you can go up to 10 o'clock at night? I admire you. I wish I could do that.
No, come here and we will show you how to go at 10 or
Okay, good.
12.
Well, that's just
in the
what I want to hear.
evening
Thank you.
to the street. Yes, for sure. Thank you very much, Larry. I
Thank
think
you.
that
Good
we
luck and good
have-
trading to everybody. I hope this has been helpful to all of you. And thanks. It's an honor to be there. So thank you for inviting me. I appreciate that.
Okay. Thank you.
See you, Larry.
See you.
Al final,
Sorry, Sandro.
no, ya se acabó. Bien, 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 bien. Bueno, aquí hay unas preguntas adicionales.
Sí, sí.